welcome to the first quarter 2026 Gain podcast of literally what just happened. There's so much to talk about. I am thrilled to have two wonderful guests on the podcast. I'm Natasha Braginsky-Mounier. I'm a trustee at Gain, and I've spent most of my adult life as a professional investor in equities at Capital Group. And I'm very pleased to welcome Gabrielle and Tara, who are multi-asset portfolio managers, and they will tell us exactly what that means. And we'll talk about this and a whole lot more. So over to Gabrielle, please.
Hi, everyone. Yes, I'm Gabrielle Park, and I'm an assistant fund manager, primarily on the multi-asset income fund at my company, W1M, but I also work across other multi-asset mandates. So that means I work across the asset classes, across equities, fixed income, and at W1M, we also invest in alternatives. So that can mean property markets and that can mean commodities, for example, as well. My specific day-to-day is I'm usually analysing companies and also looking at the world from a top-down lens. So really looking at what the main drivers of economic growth are globally.
Excellent. Thank you, Gabrielle. Tara, over to you.
Hi, everyone. So I'm also a multi-asset portfolio manager. I manage multi-asset funds that are predominantly sold through UK financial advisors. So they are designed for the UK market and appropriate for a UK client type. They invest across all asset classes as well, so equities, fixed income, commodities. And basically what my job is to vary the asset allocation within my funds as I see fit, depending on what's happening in the world around me. As part of my job there as well, I actually specialise particularly on credit. So I actually also lead our credit research group within multi-asset at Schroders. So maybe we can unpack that a little bit more later.
We definitely will, because that was very much in the news
Yes.
in the past few months. So let's start with a round the world sort of view of the major headlines this quarter. And we're not lacking headlines, from geopolitics to AI wobbles to private credit. There was something for everyone. So,
Yeah.
Gabrielle, what got your attention? What have you spent most of your time on thinking about, just from the headlines point of view? What grabbed you? What were the most important aspects?
Of course, yes. Well, I think where we are right now, obviously the Middle East is dominating headlines, and it's hard to really talk about Q3 without that, even though it has only been going in the final month here. So I guess a bit of a recap, what we've seen is at the very end of February, the US and Israel launching large-scale coordinated attacks on Iran, targeting military sites and key leadership within the country. With this specific geopolitical shock, the main reason why this is impacting, markets and economies is that the impact that this has on energy markets. And that is because of where Iran is located globally. So the Middle East exports so much energy across the world, and in particular, countries in Asia are impacted, and also Europe. So countries that have to import energy facing more challenges. So that in the short term has definitely been dominating, what we're looking at day to day.
Yeah, it's something like 20% of oil production globally that passes through that tiny little Strait of Hormuz. That sent shockwaves for sure. And Tara, what else grabbed your attention besides obviously this massive cascade of events?
Yeah. Well, I think the events in March are kind of a good reminder that markets don't operate in a vacuum. They're very much impacted by everything that's happening in the world around us, whether it's growth and inflation related, which is kind of more typical economic, or whether it is political and geopolitical. So, yeah, a lot of the attention since the end of February has been on the geopolitical situation, but maybe I'll give a few tasters of kind of how we were thinking before that, because I think often when these heightened headlines are dominating the news flow, and they are dominating market moves short term, it's easy to lose the perspective of kind of where we were before. So actually, over the first 2 months of this year, We did also have geopolitical risk, but nowhere near to the scale that we've had in March. And actually, over the first 2 months of the year, markets were actually pretty healthy. And I would say that the dominant reason for that was that the economic growth picture was actually looking pretty strong, particularly in the US. There were a few data points that were starting to point to a slightly less confident consumer, and the consumer is quite important in the economy. But generally, growth looked pretty strong, and inflation was kind of coming down towards target. So actually, a lot of the discussion over the first 2 months of the year was around central banks and at what point various central banks around the world might start to embark on a cutting cycle. So that was quite an interesting debate.
And by cutting cycle, you mean cutting interest rates, so that the cost
Cutting
of
interest
borrowing
rates,
goes down.
Yes. So central banks have been hiking rates for a number of years because they were trying to control inflation. But now that inflation's been coming back down towards their targets, which are typically around 2%, we're kind of around a bit of a tipping point in policy as to when those central banks might start reducing interest rates again. So that was quite a good debate. I would say there were other kind of risks that were bubbling under the surface in addition to the geopolitical situation, one of which was around credit concerns. So that's credit kind of refers to lending activity in the economy. And the other was around AI. And I think one of the big shifts was that a lot of the hyperscalers, so the companies that are trying to generate huge scale in cloud computing, they were starting to really invest quite heavily in their future growth. And there were questions being asked about whether that investment was really worth it and whether it was going to pay off. So those were a couple of other themes we were looking at.
It's amazing, actually, when you consider that early in the year, everyone was thinking that the rotation out of the US is going to be the dominant narrative because US markets have been so strong and US companies were so much more expensive than their international peers, and that the dollar was finally coming down, and that was boosting emerging market currencies and international markets. And it seems like in the past month, that's just completely gone backwards. How do you think about that?
Yeah, so earlier this year, it was definitely a kind of ex-US theme. So actually, if you look over the first 2 months of the year, equity markets generally did pretty well. But actually, if you look at the S&P 500, which is like your key kind of benchmark index in the US, which is actually very dominated by the tech companies, it actually barely did anything in the first 2 months of the year. But other markets like European equities and Japanese equities and emerging market equities had a really, really strong time. So we had been pivoting our portfolios more towards those areas because we thought that those would be the kind of next leg of what we call a cyclical upturn. So like when growth is kind of strong in the economy. But actually, since we've had this geopolitical risk becoming quite acute in the Middle East, and as Gabrielle mentioned, like the flow through mechanism of that is the fact that the energy price is elevated. We now find ourselves actually in a situation where there has been some permanent damage done to energy producing facilities. So even if this conflict goes away overnight, the energy situation is not going to go back to exactly where it was before. And so what that does is it increases the risk of inflation in the economy, and it also increases the risk of lower growth in the economy, because normally when you have higher energy prices, consumers and businesses get a little bit sensitive to that and they possibly scale back their activity. So the way we describe higher inflation and lower growth is stagflation risk. It means low growth, high inflation. And you can look at different economies around the world and you can actually ascertain that some economies are going to be more exposed to this than others, just purely from the nature of where they get their energy supply from and whether they're self-sufficient or not. So Europe and Asia, for example, very, very dependent on energy imports. So they are probably the most exposed to this stagflation risk from the higher energy price, whereas the US actually is a net exporter of energy, of natural gas and of oil. So they are actually ironically, given that they're one of the countries directly involved in the conflict, they are actually probably the most sheltered from that stagflation risk. So what we've done in our portfolios to kind of acknowledge that changing landscape in the risk is to move some of our equities back into the US, whereas in the first part of the year, we were rotating towards ex-US.
I also think as well, just on that point, that these types of volatile markets, that whilst, war and kind of what we're seeing is obviously tragic, and that human cost, shouldn't be overlooked. I think periods of uncertainty and sharp market swings definitely bring with it opportunities. So we're certainly thinking, trying to think one step ahead, what are the longer term implications of this? And I think, again, to Tara's point, that kind of the countries that import energy are most at risk here. And we saw when Russia and Ukraine conflict happened, Europe again was very, very much exposed and was vulnerable. And this whole conversation, I guess, of energy dependence opened up. And it really, at the time, made Europe think about, okay, renewables. Do we need to accelerate our build out there? And so again, on desk, we're thinking, what does this mean? And will perhaps Asian economies look to restart nuclear? I know that Japan, for example, are talking about turning on some of their reactors, and then what investment opportunities does that open up, in the supply chain of nuclear and materials, etc. So definitely, whenever you get a big shock like this, it's good to, I guess, take a step back and try and think ahead to what this means for shifting relationships ongoing.
Yeah, that's right. And sometimes you have hidden casualties that are kind of unexpected. And unfortunately, I think the UK may be one of them. So maybe we can talk a little bit about how different markets give you different signals and what just happened in the UK bond market with the gilts.
Yes, so we're recording on the 23rd of March, so very volatile bond markets out there. And what we really saw on Friday was, again, to Tara's point, when central banks came into the start of this year thinking that they could cut interest rates. Now that inflation it looks to be spiking and going the other way, now they may have to turn to hiking interest rates, and that's seen yields on government bonds move upwards. So they've repriced, and the UK itself finds itself in a tricky situation with their fiscal challenges. So the government needs to it obviously collects tax receipts, but it also has to spend money, and that is very imbalanced in the UK. And there is I guess a limit to how much they can look to borrow more. So the Chancellor, Rachel Reeves, finds herself in a bit of a tricky situation, and she has some fiscal headrooms that she must abide by in fiscal rules. So the pickup inflation, slower growth may mean lower tax receipts. So that again puts upward pressure on yields, and that is what we've seen play out in the bond market.
Thank you. That's one of the really challenging transmission mechanisms to understand, actually, and it kind of affects lots of other asset classes as well. Tara, how do you decide where to spend your time as an investor when the news flow is so thick and fast?
Yeah, that's a really good question, because I think as an investor, it's really easy to get distracted by all sorts of different pieces of information. So I think the first thing I would say is process. And you've got to have a process that you're familiar with in good times and bad. And that kind of helps you to navigate uncertainty. So the way we think about it in multi-asset at Schroders is we have quite a strong focus on risk management. But I think what makes our risk management different from what you might kind of see if you Googled risk management, I guess, is that we don't really just focus on risk numbers. Like you'd see numbers like VAR, value at risk, come up, or volatility or standard deviation if you were to Google like managing portfolio risk. We look at those sorts of things, but actually we believe very strongly in a scenario-based risk approach. So what that means is we kind of accept that as investors, we're always going to be wrong in some way, shape or form at some point. Actually, as an investor, you're doing a pretty good job if you're right just more than half of the time. So I very much believe that investing is about managing probabilities. And so we always have what we think is going to happen in the economy in terms of growth and inflation. Those are kind of the two most important things really as a macroeconomic investor, growth and inflation. And we always ask ourselves, where could we be wrong? And we literally fabricate these scenarios and we write a story about it of this is what would happen if we were wrong in this way. And we distill that into what we think the impact would be on growth and inflation compared to what our baseline expectation is. So at the moment, in terms of this scenario grid, we already had a scenario which is second wave inflation. And part of that scenario is elevated energy prices. So now we start to shift ourselves towards that scenario, but we've already kind of thought about what that scenario might entail. So that's kind of how we try to structure it and kind of keep ourselves on track, because it's very easy to get overwhelmed with information.
I can completely, it's on a similar stance. That's how we tend to do it as well, in that we find that we need to have a framework because there's so much information, and day by day, how do you spend your time? What do you focus on? So similar to Tara, we focus on a framework of liquidity, growth, inflation and rates. And by doing so, allows us to kind of distill the noise and allow us to assess where we think we are in the cycle and where we're going to be in 6 months' time.
Yeah, taking a step back is really hard, probably the most important thing that investors can do at times like these. How do you also deal with the information asymmetry when you're thinking about risks like what's happening in private credit or what's happening with AI overspending? Like how do you really test your assumptions and build scenarios around these big areas of risk that are pretty opaque?
So I think the first most important thing is to focus on what do you know. So what do we know? Well, we know that in private credit, for example, there's a huge concentration of sector exposure in software companies. We know that those software companies are at pretty high risk of disruption from AI. So I think it's important to just distill what do we know and look at your usual framework. So when it comes to credit as well, for example, we'd be looking at things like credit availability, like how much are the banks lending, what's risk appetite for that. And then ultimately, you need to think about what risk are you being paid to take. And so when I think about credit at the moment, so credit, by the way, is like bonds issued by companies. And the way we typically look at valuations for those is we look at how high the yield is on a specific corporate bond compared to an equivalent government bond, because governments are generally viewed to be risk-free, generally viewed. So that difference is what we call the credit spread. And if we look at credit spreads at the moment, they are very, very tight. So once you've kind of assessed, well, what do I know? What potential risk does that expose me to? And what don't I know? You kind of want to compare that to how much you're being paid to take that risk. And our assessment of that at the moment is that you're not being paid very much to take that risk.
And when you say how much you're being paid, I mean, what is your expected return?
Effectively, yeah. Right. So in this case, it's what yield am I being paid to own corporate bonds over owning government bonds, because the risk I'm taking there is corporate risk. And
which is tough because the UK gilts now are yielding between 4.5% and 5%, depending on the maturity. So that means corporate issuers have to pay even higher bond yields for you to earn a rate of return that's higher than the relatively low risk rate of UK government gilts.
Yeah, I think as well, for coming at it from a slightly different angle, I guess, on that question on, AI, CapEx, and how do you know where to invest and what to invest? So we invest at my company, W1M, directly from the bottom up. So we're looking at individual companies. And again, I guess we look at it through a framework where we have a very strict selection criteria. And one of those is the durability of the business model. So we're kind of asking ourselves, is this business going to be around in 5, 10 years time? And so actually as a house, we do remain underweight the tech sector because we do have concerns really about the level of spend and money that's going into that data center space, and whether those companies will be able to achieve a level of monetization on the spend that they're putting in. But we do have some exposure, and where we're invested is where we have greater confidence that the supply side remains more rational, and where we believe that there's a bit of a cushion of demand. So we feel that the likes of Microsoft, that is likely to be a company that we all use to use AI. So there is a bit of a, you can become more confident in the supply side of that sort of business versus others where maybe there's pockets of excess supply emerging.
Interesting. So you're very bottom up, actually.
Yes, we
in that sense.
Exactly. Yes.
Okay. And what tools are you using now that you think are most useful to you in both understanding and aggregating data or doing data analytics or just helping you stay organized? How do you actually get your work done day to day?
So we, on Death, we have Copilot, which kind of distills information. So that's a new tool that has been rolled out, over the past 12 months. We also use a platform called AlphaSense, which allows us to dig into company commentary and company transcripts, and also expert calls that are happening across the industry to really help us gain information. Bloomberg, is a very good tool, and again, they have now AI tools embedded within it. So I guess I combine all of these along with kind of the market blogs and news flow, kind of is continuous to gather everything and I guess come up with my own view.
What's the first thing you read in the morning?
I read every morning the John Authors, which is a very good newsletter, and it's actually completely free. You can get it, subscribe to it on Bloomberg. So definitely, if you're looking to keep up with the latest overnight market moves, that is one I would definitely recommend.
That's great. He's a former Financial Times journalist.
Yes, indeed.
Good stuff. Tara, what about you?
Yeah, so probably all the usual stuff you'd expect, like Bloomberg, all the kind of Microsoft suite, so like heavy users of Excel. For personal organization, I actually really love Microsoft To Do, but that's maybe aside from markets. We have various systems which are pretty slick, to be honest, in terms of how we look at our portfolios. So things like Aladdin, which is provided by BlackRock. And then the one thing I'd probably add is that actually learning to code is quite powerful as an investor. I mean, I have a scientific background, so I learned to code at university, but I'm a pretty heavy user of things like Python for automating or like big kind of calculation suites that I run regularly. So yeah, I would encourage people to learn that skill set. Actually, if you want to become an investor, it's very useful.
I'm very impressed. I thought that ChatGPT is going to do that for me someday. So
it will help you. It will help you, but being literate in the basics means that you can really leverage what ChatGPT is going to tell you.
That's excellent advice. Thank you. So as we're wrapping up Q1, and I'm conscious of the fact we still have another week to go, and sometimes these weeks are way more eventful than we ever hoped for. But as it stands, the US is holding up pretty well. US equity markets still in very positive territory. I think it was plus 5 or 6% still. Europe has sort of corrected and is maybe flat. I think March was a punishing period of time, with emerging markets in Europe losing anywhere from 10 to 12% off their highs. We saw bond yields going up. We saw the dollar still going up, and the pound, strangely, commodities rallying across the board. So these are all kind of signals of tumultuousness. How do you think the rest of the year might look like? And how should students who are now going to be looking for internships, and some of our students potentially looking for their full-time roles, how should they be thinking about job hunting in this environment of volatility and big pivotal rotations?
I think it's very challenging at the minute because so much kind of resides on how long this Middle East conflict happens, keeps going for what's going to happen for the rest of the year. Because as we touched on at the beginning of this podcast, before we saw those events unfold, markets and the economic backdrop was pretty strong. And I think as well, particularly in the US, there is a lot of fiscal support, and Donald Trump has his midterm elections coming up, and he will not want higher energy prices. We've got his One Big Beautiful Bill Act is also coming through, and that will see, tax refunds, rebates to many consumers, which should enable them to keep spending. And so if the energy picture is under control, you can paint, a pretty positive economic backdrop from here. So it is very uncertain at the minute and difficult in that regard. Tara, I don't know if you've got anything to add.
Yeah, it's hard to look through what's happening immediately in front of us. But I think, again, what we have to remember, kind of what I mentioned at the start, is we did go into this in a fairly strong position in terms of the cyclical backdrop. Like the economic cycle was pretty healthy, and it looked quite constructive for risk assets. So things like equities, corporate earnings look strong. So, those sorts of things could well support us through the rest of the year. The big challenge is this stagflation risk that we have from the energy prices. And so a lot is going to depend on how long this persists for, and therefore what the reactions of the central banks have to be as well.
Tara, stagflation is when you have higher than expected inflation and
lower than expected growth. It's a really toxic mix for markets. It's basically what happened in 2022, which was a horrible, horrible year.
And why is it so bad? What makes it so toxic?
It's bad for markets because the higher inflation starts to reflect in higher bond yields, which means that your bonds are falling in price. That also makes financing more expensive for companies, and the way you value companies, you're typically discounting cash flows back to today as well. So when you have a higher yield, you're discounting your future earnings back of a company. Your valuation that you're willing to pay for a company basically falls. And then there's also the risk that it starts to hit growth in the economy, because when interest rates are higher, the cost of borrowing is higher, and it just generally contracts economic growth as well. So it's typically results in falling equities as well. So for multi-asset investors like us, it's the worst environment, because you have your bonds falling in value and your equities falling in value.
It's a vicious cycle.
So it's not very nice, yeah.
No.
So I think, we should acknowledge that high risk of stagflation, and that's where we're pretty cautious about owning corporate bonds at the moment, because, as I said before, you're not being paid that much to take the risk of those bonds. And so against the risks we're facing, it just doesn't seem like a good payoff. So again, back to the point that I think of investing as managing probabilities. So I'm kind of looking for the areas of the market where I think the probabilities are not in my favour.
And Tara, what's the first thing you read in the morning? We didn't ask you that.
I quite like the early morning read from Jim Reed, and then the Financial Times. And because I'm very focused on credit as well, I tend to read the broker chats on credit markets and kind of what's been issued and what's trading and changing hands.
And Jim Reed is very well known in financial circles.
Yes.
One of the longest lasting, I think, market strategists from Deutsche Bank.
Yes.
Right. So he's been around. He's seen a lot of market cycles. I guess my advice to students would be to very much take the long-term view, and that there's always going to be an opportunity in the market somewhere. Volatility sometimes creates more opportunities to invest for the long term. And you want to make sure that the firm is stable enough, the firm you're interviewing with or looking to work at, and diversified enough to be able to have a long-term view, because markets can stay irrational longer than we can stay liquid. That's the one of the first rules that I've learned as an investor. So in the long term, actually, markets recover from shocks pretty quickly. And I'm always thinking back to those horrible weeks and months in 2020 when COVID first hit. And markets, I think, collapsed by almost 30% then, but they bounced back very quickly, as they did after the Trump tariff tantrum and whatever they called it, Liberation Day. But often these shocks are actually much more digestible than they appear. And if you only concentrate on the shocks in the near term, you might miss the big windows of opportunities that open up for the long term. Any other advice you have for our students in terms of becoming financially literate, having investment acumen, what to read, what to listen to as they prepare for a career in this field? Gabrielle.
Yeah, I guess read as widely as you can. And I think that doesn't have to be investing. Understanding politics, understanding history, industries, how different companies work. I think it just all helps to build a broader perspective. And the real edge, I guess, in investing comes from thinking differently, and being able to connect ideas that other people might not have thought of, or might have missed. And I think, us particularly, as a woman, and different genders, diversity can be really helpful, and we should definitely leverage that. So, for example, I feel that I often notice particular consumption trends maybe before my male colleagues. They're not really looking at what the latest beauty trends are, and what that might mean for consumer discretionary stocks. So I think definitely where you're gathering knowledge doesn't have to just to be finance and investment literature. Reading as widely as you can be really, really beneficial.
Excellent advice. Yes. Tara, and you?
Yeah, I think I would say try and speak to as many people as possible. I know it can sometimes be hard to get contacts in the industry, but you've just got to chip away at it, because one person might introduce you to another, and they'll bring fresh ideas as well. And I think one of the hardest things when you're trying to join the asset management industry, for example, is actually even knowing what jobs there are. And it's really hard to get a view of that when you're on the outside. And there are actually so many different jobs in investment. And that's what you need to try to start to understand, and then think about which of those really maps into your skill set and your interests. I'm always amazed, like, compared to what I thought an asset manager was when I was at university compared to what I see now, having been on the inside for 12 years. There are just so many different roles out there.
Absolutely. And we are really, really blessed at GAIN to have support from so many different kinds of organizations. And you two are examples of that. Schroders being a huge brand name and a dominant asset manager in the UK, and WM1 being a wealth manager, maybe a company that students have not heard of, but is definitely one of the best boutiques for wealth management and private sort of family office services. And the kinds of jobs you have today sometimes didn't exist 10 years ago, actually. So it's also really good to know that it's such a dynamic field, and you've got to do your homework. So with that, let's wrap up. Any markets advice to students?
I think just try to separate out from the noise. Just, it's hard when the headlines are so in your face, but there's a lot of things that have happened in the quarter, and it's not just the conflict in the Middle East. So try to keep perspective on the bigger picture.
Gabrielle?
I think it related to that point. I think long-term thinking, and maybe beyond the immediate effects. We've focused a lot here on kind of energy prices and kind of short term, what will play out over the next 6-12 months. But I guess, how will the world look in 3-5 years time, and thinking that one step ahead.
Absolutely. Great advice. And students have free access to the Financial Times, so they should definitely be reading those morning updates and Alphaville, and listen to the Unhedged podcast with Katie Martin and Rob Armstrong, and be really in the flow of what's happening, but think ahead, because that's what markets do. Markets are forward looking, and that's why this is an exciting career path. Thank you so much, both of you, for joining. All the best to you. Thank you, Gabrielle and Tara.
Thank you very much.
Thank you for tuning in to the Girls Are Investors podcast. If you'd like to know more about how GAIN can support your investment management career, head to our website at www.gainuk.org, or you can find us on Instagram and TikTok at gainuk_org. See you next time.